So we want to conclude our videos on dividend payout by looking at, again, some agency costs and some other hypotheses and theories about the impact of changing dividends and that impact on stock price. So let's think about distress costs. Essentially, companies want to keep some cash just in case they have some shortfall, right? Even though there's a tax disadvantage, right? So again, we may have a large cash flow, especially if we think maybe future earnings aren't going to be sufficient. Maybe if we have big investments that are coming our way that are positive net present value opportunities, there are reasons why we may want to maintain some large cash balances. So the cost of holding cash, right, has to be compared to the reduction in transactions, agency costs, adverse selection costs, all those aspects that go along with issuing new capital, right? So in the end, this is all a big trade-off, right? We need cash for investing, but we also need to make our shareholders happy. So when firms have excess cash, what happens to managers? And managers might not be as conservative with our excess cash. They might not be good stewards of this windfall, if you will. So if they're paying out extra cash through dividends or share repurchases, then their ability to reduce reduce their wasteful spending is reduced dramatically, since they don't have this extra cash laying around. Now again, it also is dependent on the companies and their future growth, right? So it's not surprising that high-tech and biotechnology companies tend to retain lots of cash. They don't pay out a lot in dividends because they need this cash for the future growth of the company. So now let's think a little bit about something referred to as signaling. We talked about this in some previous videos. The dividend smoothing is the idea to maintain relatively constant dividends, and we don't change them very often. Well, why do we want to have constant, smooth dividends that don't change much very often? Well, essentially, this is what we found from research. Management believes that investors want stable dividends, and they desire to have a long-term level target, if you will, of dividends. So if companies raise their dividends, essentially they're only going to do that when they perceive a long-term sustainable increase in the ability to keep them there. So said another way, managers don't want to reduce dividends. If you reduce dividends, investors are going to think something is wrong. Why do they think something's wrong? Well, they don't know what's wrong. They just know that you now have decreased the cash flow that they're used to receiving, and they perceive that as being a bad sign. So when you increase dividends, they see that as a positive sign. So the idea, again, that dividend changes reflect the views about the company's future prospects. If they smooth dividends, the dividend choice is going to then contain information about what they think about the future. Again, we're just coming back to the same basic idea then. When a company increases its dividend, it's sending a positive signal. If it decreases a dividend, it's sending a negative signal. Now, this is all dependent on information, right? Although an increase in their dividend can reflect optimism, it might also signal a lack of investment opportunities. likewise, reducing a dividend could be part of a strategy to purchase some positive net present value investment opportunities. So this process of signaling, we refer to things like the signaling or the asymmetric information idea, is that managers know what's going on. So if managers think the future is better, they may increase the dividend. But if they decrease the dividend, why might they do that? If they have a great investment, maybe they want to use cash rather than issue stock. So if they were to tell investors what they were going to do with this reduced dividend, right, the money that they didn't pay, investors may see that not as a bad sign, but as a negative, as a positive sign. So the signals that are sent are very true, and they're always going to hold unless there's additional information given to the public. So what about share repurchases? What signal do we get from that? Again, share repurchases are a credible signal that the shares are underpriced, right? Again, investors believe that managers have more information than them. And again, you would only buy things if you thought the price was going to go up or the value was greater. So share repurchases are seen as being a positive sign. A final theory about dividend payout is something that the book doesn't directly relate, but I think it has some importance in understanding the trade-offs that go on in making dividend policy decisions. The Burdenhand theory basically states that paying more dividends will increase the value of the stock. It says that dividends are relevant, that they will change stock price. And the underlying concept here is that the receipt of dividends is far more certain than the receipt of capital gains. We've been talking about in this signaling concept that managers like to have smooth, stable dividends. So what happens if you are receiving a dividend over time? You expect that to continue. So dividends are fairly certain. Capital gains are not, right? They're based on the stock price. You don't know when you're going to sell the stock. So there's a lot of uncertainty with the receipt of capital gains. So if a company increases the payout of dividends, it's reducing the riskiness of the returns to the shareholders. I mean, even if it's the same rate of return, it's now a rate of return that's more certain because dividends don't change very often. And we've talked throughout these videos about the risk-return trade-off. As risk decreases, investors are willing to take lower returns. This implies that they're expecting to have a price increase. So companies should attempt to maximize dividends in order to create a maximum stock value. Now, this Burdenhand theory disagrees with most of what we've talked about in the past couple of videos. However, in the end, this is a trade-off model, right? We have to assume that investors like to get dividends. We also have to assume the company needs cash in order to invest. Shareholders want the company to invest because they see ultimately there's capital gains that can be achieved. So the management of the company has to trade off how much cash is paid off relative to the investment opportunities that they have. So it's not a straightforward, uncomplicated decision. There's lots of things at play when you think about how much dividend to pay out. Now, the last thing that we'll talk about is the concept of stock dividends and splits. right? So a stock dividend, or when a company pays a dividend, it doesn't pay cash, it distributes shares. So the total market value of the company is unchanged. The only thing that's different is the number of shares outstanding. Now the stock price is obviously going to fall because the total equity value is now divided by a larger number of shares. But on the other hand, the percentage of shares, the ownership of the company, is now valued or is now divided by a fewer number of shares. So let's assume Genron here pays a 50% stock dividend or a 3-for-2 stock split rather than a cash dividend. If you own 100 shares before the dividend, you have $4,200 in market value. After the dividend, you have 150 shares, but because the portfolio is still worth $4,200, this stock price is going to drop to $28. So when a company participates in a stock dividend or split, nothing really happens to the owners. And I can say this with certainty because stock dividends and splits are not taxed. So if the government says they don't want tax from a transaction that you make, what they're telling you is the transaction did absolutely nothing, right? So again, the number of shares is proportionally changed. Likewise, the price is proportionally changed, so there's no change in value to the owners. Now, that's not to say that it's not good to have a stock that splits, because now you have, especially if it's like a 2-for-1 split, you now have more shares. The typical motivation for stock splits and dividends really is to try to make the stock more attractive, especially to small investors. If the share price gets too high, it's difficult for people to buy it. So if you can keep the price lower, right, we may be able to make the stock, again, more attractive. So if the stock is selling for $300 a share, not too many people can buy 100 shares at $300 a piece. But what if we could split that? Let's do it kind of crazy. Let's do it 10 to 1. For every 1 share, you get 10. Now that's going to be reduced by 10, right? So instead of having it being $300 a share, now it's only $30 a share. And a lot more people can purchase the stock at that price. So there's an implication here that there is an optimal trading range where shares seem to trade quicker. There seems to be a little bit more liquidity in the stock market. On the flip side of this, there's also something called a reverse split where, if the company thinks the stock price is too low, they may want to get the price to go up a little bit so it looks, again, more attractive. Again, a $5 stock, not even looking at the company, but a $5 stock compared to a $20 stock doesn't look as attractive. So if we were to do a 1-for-4 split on a $5 stock, in the end, the stock would then sell for $20 a share, and the company would, in quotes, the company would look better. It'd be more attractive. At the very least, more people might research the company to determine whether it's a good investment, so there would be more activity. And finally, we have something referred to as spin-offs, and this is just a distribution, if you will. But essentially what we're going to do is we're going to spin off part of our company by selling shares in that subsidiary all by itself. So some non-cash special dividends might be used to spin off assets, right? So we could spin off a company, create shares, spin this company off, and not spend any money, not gain any money, but create these stock dividends, if you will, to create this new entity. And the reason we might want to do this, Number one is we're going to avoid some transaction costs. This special kind of a dividend is not taxed as a cash distribution, but why might we want to spin off a subsidiary and have it trade by itself? Well, the reason might be a valuation question. If we think that this company, I mean, it's not a bad company, but it's taking away from the value of our main business, maybe as a separate company, it will survive and it will do okay. But if we spin it away, maybe that will increase the value of what we currently have. So the idea here is maybe that separately the two are worth more than what they were together. So that is the end of our discussion on dividend payout.